Robert Schein, CIO of Blanke Schein Wealth Management, joins us with his take on the markets. Robert, lovely to have you on the show. Thank you very much for your time. What did you make of yesterday's sell-off? We are getting close to a correction zone in the S&P 500. How much more to go, you think, from here in terms of opening the downside, where the market really prices in this unpredictability around trade policy, government policy, and what that really means for recession fears?
It's hard to imagine. Just a few short weeks ago, we were hitting all-time highs on all the indices, right? And so, the sell-off continues in the heels of last week's market, and we saw that play out today. I don't believe that we're close to the end just yet, especially since we're testing some of the technicals in the S&P, the 50-day, and now the 200-day. So we have to pay attention. But the reality of the situation, last time I was here, on with your programming, I said, the word is patience and diversification and balance. And so we, for our clients, have kept some dry powder. We understood there was going to be tremendous volatility. And I think, every single minute, we're going to get a different headline. So you just have to stick to your guns and look for quality in markets like these.
And so from that standpoint, what has been your tactical reallocation strategy or redeployment strategy? What are you telling clients?
Yeah, we had an event the other day, and we had all of our clients are just as concerned as I'm sure all the audience is, because that uncertainty really strikes home. And so my clients, we employ the diversified and balanced strategy. And as I was saying to them, if the markets go up, you're not going to like your bond portfolio per se, because the equity market takes off. And if the market sells off, you're going to like your bond portfolio, because then we can reallocate strategically and then buy some high quality stocks that are on sale that we're seeing right now. So it's I don't know strategy, but it keeps us safe and it keeps our clients engaged. And we'll see, we'll ride this out. And I think there's going to be a lot of opportunities that are going to shake out over the next few weeks. So I'm actually constructive on what we're seeing and encouraged.
Okay. How are you viewing what's happening with the dollar right now?
So, we're seeing the dollar weakness continue to play out. And quite frankly, the U.S. growth is in question, right? We're going to see the GDP potentially continue to slow in the U.S. It's growing, but it's not maybe growing as fast as one would have liked. And then you look at other countries are now starting to grow. You're seeing green shoots in Germany, as an example, and other countries. And keep in mind, they have a little bit more accommodative policy from their feds, if you will, respectively, than our Federal Reserve. And our Federal Reserve has to sit on their hands right now and wait for the data tomorrow, or actually Wednesday and Thursday, where we got some more inflation numbers that is going to be all eyes on the Fed and all eyes on that data. So that's going to sort of put into underneath the underpinning the interest rate policy, which is keeping sort of the dollar weakness play out.
Yeah. In your notes, you've highlighted that cash is a good position right now, and that cash position should be parked in short duration bonds because you're getting risk-free 4-5% out there. So you're essentially looking at 2-year T-bills?
Yeah, we love them. You get paid while you wait, and you have complete liquidity, and you're putting that money to work. And so we know that, we're getting a great rate of return on a, ultra safe asset class. And we're just continuing just to let the market play out. And again, there's a lot of quality that's selling off with the rest of the market. And that becomes encouraging if you're just patient and choose your spots in the companies that you want to add. And maybe, quite frankly, you didn't have a chance to add them before.
Right. And I also want to highlight your stock ideas, Costco, Berkshire Hathaway, because obviously they have a big pile of cash and that's just growing. Warren Buffett, of course, has been raising his cash levels now in excess of $300 billion. So cash is king, and you think that's a good bet because obviously it's a great dividend play. Total return strategy is very good with this stock. And then Netflix as well.
Yeah, all of those are great for a long-term investor in their portfolio. And what I love, let's just start with Costco. Costco makes the majority of their money before you and I ever step a foot in their stores simply because of membership. And their membership, oh, by the way, is growing. And their same-store sales are growing. And last week's conference call, Costco basically said that there's no change in the consumer. The consumer specifically is now choosing what aisle they particular want to shop down versus the other. And oh, by the way, goods beat the food aisle in Costco. So consumers are still hanging in there, and Costco has just reaffirmed that's the case moving forward. Obviously, like we always love Warren Buffett with the cash haul that he has, and he waits for markets just like this, as we do, to jump on it. And finally,
Netflix.
Yeah, Netflix is again, that is growing. They're winning the global streaming wars, and they've done a lot of great things, from membership growth, pricing optimization, and now they're basically advertising. 55% of the last quarter's new subscriber growth are opting for the ad option plan, which is another driver for income that didn't exist before for Netflix. So they're growing on all cylinders, top line and bottom line, and they're continuing to create great new content.
Right. Robert, stay right there. We'll discuss a lot more with you when we come back on the other side of this break. We haven't touched upon the Mag 7, so talk about that a little bit when we come back in 2 short minutes. And R&D, right? Okay, great. Let me take that story forward with our guest. Thanks very much, Arjun, for bringing that to us. Robert Schein is with us still from Blanke Schein Wealth Management. Robert, your own take on how Apple is creating this whole AI universe for itself that it can own and deploy and implement.
Apple is continuing to be a leader. They might not be first to the party, but when they start and they finally show up, they lean in, and usually they get it right. And if they don't get it right the first time, they don't just rest on their laurels. But it's remarkable to see all the AI spend and how Apple is trying to keep it on its own ecosystem and across all lines of changing everything. The AI is going to obviously be the future, and fast forward into the future. Apple's going to be part of that race and part of that spend as well.
Yeah, but the point that, obviously Arjun was raising about Apple versus the rest of the pack, especially the Android group, which is heavily dependent on Google's Gemini. Do you see that diversifying? Do you see more players coming in? And also, how does all of this set in at a time when the backdrop is looking so uncertain economically in terms of additional investments going into AI development for some of these tech players?
There's no question. It all remains to be seen how this AI war is ultimately going to play out. And there's going to be multiple winners. The technology is there, but it's getting better by the second. And there's going to be multiple winners and multiple companies that are coming in with sort of dynamic models that are going to change the entire space as we know it today. So whether it's Google today or Apple today, and they're squaring off, there's many other companies that are quickly catching up in the AI space. So, I reckon that, if we were to be here 1 year from right now and having this conversation, there's going to be multiple players that not many people have even thought of in that space right now. And so that's why these companies have to spend and continue to work feverishly around the clock to continue to innovate.
Right. And this Mag 7 sell-off, buying opportunity or not quite?
Yeah, Mag 7 has specifically led for the longest time. That sector has been a leading sector the last 5 years. So to see that, slow down, that rate of change is changing in terms of their growth rate, but they're still growing. But we're seeing the broadening out as well as earnings broadening out in other 10 sectors of the S&P 500. We still own Mag 7. We still like Apple. We still like all of those. In fact, Amazon's one of the best of the Mag 7s as it's reasonably priced. Their operating margins are increasing. They have advertising that's increasing, cloud computing that's continuing to grow. So they're firing on all cylinders, and they have solid organic growth. So, Amazon's the one out of the Mag 7 that we believe is priced, something that if you don't own the portfolio or you want to average in, be patient over the next few weeks, start adding it.
Tesla. We have a minute to go. Very quickly, I want to get your thoughts in. Major distraction discount.
Yeah, Tesla, I had a client email me this afternoon and about his Tesla position. And, it's one we're going to hold. We have a, low cost basis and we're going to continue to see how this plays out. If you don't own it, that's another company for the future. So obviously, Elon is very distracted. He's got, multiple jobs and multiple companies, but he's also very successful. But he has to pay attention to Tesla. But I think they're driving now in terms of their revenue growth continuing to grow. And if they're not continuing to grow, he's going to reprice it so that the growth of all of their models continue to, fly out the doors.
Robert, lovely to have you on the show. Thank you very much for making sense of the markets in this mayhem. Appreciate your time and your insights. We'll be back in a few minutes.